Welcome to the Dinar Trend Tracker. Millions of investors are in a state of extreme bewilderment and shock after this morning's disturbing disruption of the world's currency markets. Those who have invested in the Iraqi Dinar or the Vietnamese Dong will find the screen numbers quite disorienting. People have been hoping for a future economic rebound, and significant speculation surrounding these two currencies for a long time has gone through an unexpected and steep fall, surprising even the most seasoned market observers. From Asian and Middle Eastern trading floors to online forums where investors from around the world congregate, what is being referred to as the 25 currency shock has caused enormous tremors. Before hasty decisions are taken in the heat of the moment, there is a deluge of anxious social media messages and questions as many people attempt to make sense of a scenario that appears to have developed seemingly overnight. We must stop and analyze the complicated chain of circumstances that has brought us here. We will examine the underlying causes of the fall and what these new developments may mean for the future as we dive into the mechanics of this unexpected market shift today. If you're an investor who has just taken an interest in the Dong's growth potential, or if you've been following the Dinar's narrative for over a decade, you're a long-term holding. Important details are going to be covered. To successfully navigate one of the most turbulent epochs, it is necessary to comprehend the causes of these enormous changes. Recent events in the global market have presented an opportunity to replace pessimism with knowledge. First, let's take a look at the numbers that everyone is so worried about. An unprecedented 30% decline in value has been seen by the Iraqi Dinar in just the past week. This is not a small adjustment or fluctuation, it is substantial. This sharp and severe decline was not predicted by any of the available analytical models. In a similar vein, the Vietnamese Dong, despite its history of resilience, has lost about 25% of its value versus major currency pairs due to the upheaval. The terrible truth is that many individual investors have seen their portfolios plummet in what seems like the space of a second as a result of this. The immediate repercussions of this slump are being seen in important financial centers that facilitate trade in these currencies, wiping out months or even years of imagined gains. The extraordinary increase in sell orders reported by the Dubai, Istanbul, and Ho Chi Minh City exchanges is indicative of the generalized panic that is gripping individual traders. There have been major operational issues caused by this unexpected evacuation. Liquidity issues arise with our TNG even with large-scale currency brokers when the number of sell orders exceeds the number of purchasers. All signs point to a massive market change, a seismic event that could send shockwaves of uncertainty through a plethora of developing market countries and prompt a worldwide reassessment of risk and exposure. Everyone is wondering, in an effort to solve the riddle of the dinars, what combination of events might cause such a sharp and coordinated fall. Drop abruptly. We must begin our examination with Iraq's enormous oil reserves, the foundation of the country's economy. Oil export income comprise over 90% of the government's total budget, demonstrating the inseparable relationship between the nation's financial health and the global energy market. An inherent weakness is introduced by this profound reliance. If oil prices remain high and stable around the world, the Iraqi economy will receive a consistent flow of funds. But lately, the energy markets have been very volatile, whipped around by rising geopolitical tensions in important areas and unpredictable shifts in global demand. This has created an extremely unstable oil market, which has hampered Iraq's budgetary planning and economic forecast. The Iraqi dinar is subject to market pressure. When oil prices drop or become unpredictable, it raises serious concerns about Iraq's ability to pay its bills, fund the national budget, and keep its foreign currency reserves intact. Investors from around the world are understandably worried about the safety of the Iraqi dinar and the central bank's capacity to protect its value due to this uncertainty. This sets off a chain reaction of sales that can gain steam very fast. The initial conditions for a downturn were created by a combination of falling oil prices and domestic political uncertainty, but reports of major delays in passing the national budget and rumors of internal disagreements over important fiscal policies have added fuel to the fire, further eroding investor confidence. A challenging scenario became a full-blown crisis due to another, considerably bigger global factor. The mighty power of the US dollar is that force. As a result of the most recent US Federal Reserve policy decisions, the dollar has risen to its highest level in years, putting tremendous pressure on currencies in the developing world. One way to look at the global financial system is as a giant seesaw. When the dollar strengthens significantly, it attracts capital from around the world, which means that investments in emerging markets are pulled back into the perceived safety and higher yields of US-based assets, like government bonds. One side will always climb to reflect the US dollar's strength due to rising interest rates and its position as the world's principal reserve currency, while the other side will undoubtedly decrease to reflect the currencies of emerging markets. In the field of international economics, this negative link has been extensively demonstrated. When smaller economies lose money, their currency loses value, their borrowing rates rise, and inflationary pressures might become worse. Although this has an influence on countries like Turkey and Egypt, the dong and dinar have felt it the most. Now, let's focus on the Vietnamese dong and the specific factors contributing to their depreciation, since their speculative character makes them especially vulnerable to sudden changes in worldwide investor mood. Over the previous decade, Vietnam's economy has been hailed as one of the most dynamic and fastest growing in Asia. It has become an important part of the world's supply networks and a major center for global manufacturing after successfully attracting massive amounts of investment from outside. The country's welcoming climate and highly trained workforce have attracted numerous international firms, who have set up substantial operations there. A strong and quickly growing economy is no match for the strong currents of global economic shocks, as the recent recession has shown all too clearly. Exports of Vietnamese manufactured goods are crucial to the country's economy, but they are highly dependent on steady demand from key foreign markets including the US, Europe, and China. Several of these crucial marketplaces are, alas, experiencing economic storms of their own right now. Vietnamese export volumes have been hit hard by the recent and noticeable slowdown in China's economic growth, as well as by a decline in new orders from Western economies that are struggling with inflation and sluggish consumer spending. The dong is under pressure due in large part to this slowdown in export growth. The combination of falling export demand and increasing inflationary pressures within Vietnam's domestic economy is a recipe for disaster, as it portends a possible slowdown in the influx of foreign currency into the country. Rising living expenses have been a burden on companies and families. As a result, the State Bank of Vietnam is trying to walk a fine line between two very precarious positions. It must, on the one hand, encourage further economic expansion and keep employment steady. On the other side, maintaining stable prices requires it to fight inflation. The aggressive run of interest rate hikes implemented by European and US central banks has made this task increasingly more difficult. It aids in the decline and restricts Vietnam's own policy alternatives. The dong is facing a difficult environment due to the combined effects of both internal and foreign pressures on its currency. Whoever staked money on Vietnam's unchecked growth tail is now feeling the pinch. Many individual investors are now asking themselves an important question in light of this unexpected and steep drop. Is this a hint that their investing thesis is failing, or does it ironically portend a new, potentially dangerous, buying opportunity? The dinar and the dong have both traditionally been seen as having great long-term potential, that is, if their economies mature, become more integrated into the global system, and stable, their values could rise substantially. But the market is absolutely bewildered and terrified by the kind of short-term volatility we're seeing right now, so it's hard to think rationally about the long run. While these precipitous declines are certainly unpleasant, some market watchers argue that they do not necessarily portend a systemic collapse of the underlying economy. On the other hand, they may be seen as inevitable sharp corrections in extremely speculative markets that were probably ready for a reality check. However, keep in mind that trading currencies is very different from investing in stocks. This is something that everyone engaged must keep in mind. Cryptocurrencies do not make money or distribute dividends. Their worth is directly tied to the volatility of prices, which can be unpredictable and quick to change as individual investors deal with their emotions. Behind the scenes at hedge funds and institutional investment businesses is a very different story. There is no sign of panic among these expert dealers. Their approach is systematic and calm, and they are keeping a careful eye on a small number of critical data points that will guide their actions. On top of price charts, their screens display up-to-the-minute data on Iraqi oil output, inflation trends in Vietnam, and, most importantly, the US dollar index. That compares the value of one major currency to another. These astute financiers work on the premise that market panics can frequently lead to advantageous long-term positioning. They are cognizant of the enormous dangers, but they also have the means and intelligence to ignore superficial concerns. For instance, they are keeping tabs on Iraq's persistent attempts to enhance its oil infrastructure and its pursuit of more advantageous international trade agreements, both of which have been progressing slowly but surely. At the same time, they are studying the ongoing trend of MNCs redistributing manufacturing from China to countries like Vietnam and diversifying their supply chains. You can still make a convincing case for a full recovery, according to both of these underlying stories. Having said that, these experts don't kid themselves into thinking that the road to recovery would be smooth sailing. For a more complex picture, let's investigate Iraq's present economic situation further. The country's oil production has been steadily increasing, even though the headlines are often dominated by the continuous political conflicts and security challenges. In order to increase export volumes, the Iraqi government has been investing in modernizing its refineries and laying new pipeline. These basic operational changes should, in theory, provide a more consistent flow of revenue, which should give some long-term support for the dinar's value. The nation's most precious natural resource is about to reach its full potential, and these initiatives are a concrete step in the right direction. Nevertheless, the persistent presence of significant structural weaknesses in Iraq's economy consistently undermines this encouraging trend. Foreign investment is discouraged, especially outside of the energy industry, due to the pervasive corruption that continues to eat away at national resources. On top of that, being so reliant on oil revenue makes you vulnerable all the time. Iraq will feel the pinch the moment the world's energy demand drops significantly, whether that's due to a global economic downturn, a change in geopolitical allegiances, or the rapid shift towards renewable energy. While a diverse set of economic forces shapes Vietnam's outlook, the uncertainty of the global energy situation continues to impact the dinar's prospects into 2025. Rising prices, especially for necessities like food and energy, pose the greatest threat to the home economy. The expense of doing business and the quality of life for its residents are both affected by this. Stricter lending standards and less government spending are the main weapons in the government's arsenal against this. However, there are repercussions to this strategy all of its own. Because it has the ability to dampen consumer demand and small company expansion, which could lead to a slowdown in the economy. Investors are understandably worried about the future, especially in light of the fact that early economic data from 2025 shows a discernible slowdown in export growth compared to the spectacular results from the previous year, all because of this policy dilemma. Everyone is now waiting to see how the Vietnamese government handles this perilous situation. Will they opt to re-stimulate growth by loosening monetary policy, which could lead to greater inflation? Otherwise, will they stick to their hard line against inflation, risking economic growth in the near run in favor of stability in the long run? The worth of the dong will be significantly affected by their decision. Positively, after the present global unrest passes, the currency may be stabilized by the long-term industrial momentum, which is fueled by foreign investment in technology and manufacturing. So, what does the average person holding these currencies need to know about this complicated and fast-changing situation? Refraining from giving in to the overwhelming temptation to act out of fear is the first and foremost guideline. While it's understandable to feel emotionally drained when values suddenly plummet, selling in a panic usually just locks in losses for good. At this time, it is more prudent to sit quietly and reconsider one's initial investing idea. Have these recent events irreparably changed the basic long-term economic considerations that originally justified the investment? That is the crucial question to ask. This extreme short-term volatility may not shake many people's fundamental faith in the long-term possibilities of Iraq's reconstruction or Vietnam's industrialization. It is advisable to re-evaluate one's exposure carefully if one's personal financial status has altered or if this recession has beyond one's risk tolerance. A heightened sense of caution is absolutely essential for anyone contemplating investing during this downturn, but responsible investors are using this event as a chance to review their entire portfolio, making sure they are diversified and not overly concentrated in any single speculative asset class. This will strengthen their financial position for the future, not panic. Although a 30% drop would sound like a good deal, it's a well-known fact in the market that currencies, just like any traded asset, can keep going downhill even after they hit rock bottom. It is infamously tough to try and time the market correctly. The challenge is so great that not even the most seasoned traders are able to complete it. Thus, it is critical to enter the market now only with funds that one can truly afford to lose without endangering their total financial security, otherwise, it is a high-risk endeavor. The goal shouldn't be to hope for a fast turnaround, but rather to set oneself up for a possible long-term recovery. If market volatility persists for an extended length of time, some investors may find it helpful to spread out their purchases by purchasing smaller, more frequent amounts. Some may choose to sit on their hands until they observe undeniable signs of economic stabilization, such as steady improvement in Iraq's budget process or a revival in Vietnam's export figures. You must realize that while both of these approaches are legitimate, there is no assurance that you will make money. At this juncture, it is also important to address a persistent and frequently misleading narrative that circulates within the investment communities for these currencies. The real skill in navigating these markets is patience and a deep understanding that financial markets rarely move in straight, predictable lines. The concept of an unexpected overnight revaluation that can lead to a dramatic increase in the value of the dong or dinar. Such tales have long been commonplace on internet discussion boards, and they have the potential to mislead readers into making ill-advised financial investments. Reevaluations of currencies occur very seldom in the actual world of international finance. They are not unanticipated bonuses, but rather the result of meticulous planning and strict management. As part of a larger, internationally regulated program of economic reform, governments and central banks often undertake economic adjustments. Market fluctuations like the ones we're seeing right now are caused by major economic forces and changes. The mood of investors and the inevitable, though unpleasant, market correction. They do not herald an unseen impending revaluation. A solid grasp of macroeconomic patterns and solid statistics have always been the bedrock of the most successful and long-term investment strategies, rather than wild guesses and unsubstantiated internet rumors. Any investor would be well served by taking the time to understand the complex relationship between international trade flows, energy markets, and global interest rates. Many market observers are coming to the conclusion that volatility will continue to be a distinguishing feature of the currency markets as we move through the rest of 2025. Strong US dollars, volatile oil prices, and realigning global trade balances are the huge global dynamics that caused this initial slump, and they aren't going away anytime soon. This presents a formidable obstacle that Vietnam and Iraq will have to overcome. Worldwide setting with remarkable panache and vision. How well their currency does in the coming months and years will depend heavily on how well they can adapt. Moving forward, Iraq must redouble its efforts to implement comprehensive financial reforms that will increase transparency and decrease corruption. It must also devise a real plan to diversify its economy away from its heavy dependence on oil. The main obstacle that Vietnam must overcome is effectively controlling its own inflation rate without attracting the foreign investment that is vital to its economic development. These are two really challenging pathways that require a lot of hard work over a long time to complete. In conclusion, investors should brace themselves for further ups and downs on the road to a genuine and long-term recovery. Investors throughout the world are understandably worried about the future value of their Iraqi dinar and Vietnamese dong holdings due to the undeniable wave of worry that the 2025 currency shock has caused. But keep in mind that freaking out is never a good plan. From the right vantage point, this severe recession might be perceived as either a harsh financial lesson or a great chance to re-evaluate and improve. Relying solely on the way one reacts. The best way to go is to stick to a well-planned strategy, ground your expectations in reality, and control your emotions. The two most important things an investor can have during these extremely volatile times are knowledge and patience.